Welcome to the HC Commodities podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Today we're talking liquid petroleum gas, LPG, which is also part of NGLs here in the US. What are they? Where are they used? And what is the market for LPG? And how has that market transformed in the advent of shale and the energy transition? And what lessons are there for other commodities about the evolution of LPG trading and the skill sets it requires? Our guest is Jack Nugent. Jack is the founder and director of Tradavex, a strategic advisory firm that sits at the interface between technology and commodities, helping clients understand and deploy technologies in a commodities trading context. Jack brings a unique perspective, both from his early days in LPG broking to living and working in both Europe and Asia as an LPG trader. He later co-founded his own successful LPG trading company. Jack has seen the LPG market from every angle over the last 15 years. As always, you can really support the show by leaving us a positive review on the platform you're listening on or subscribing to the show on YouTube. And as always, I hope you enjoyed the episode. Jack, welcome to the show.
Thank you very much, Paul.
So today we're talking liquid petroleum gas, or LPG as we'll refer to it going forwards, which I guess is in some ways a herald of how commodities go through a transition of how and who is trading them, but also somewhat of a herald about how the energy transition can transform a commodity. And it also sits, as all these commodities do, centrally in the ongoing trends, including digitization, including deglobalization, and of course, decarbonization. So I guess let's lay the groundwork before we start talking about the trends inherent in the market. What is LPG?
Yeah, sure. So, LPG is propane and butane. So they're known as C3 or C4 by the carbon molecules. And they are typically obtained from either field grades from oil and gas production or refinery grade from fractional distillation. And the main sort of uses for them are that they can be used in heating, cooking, petrochemical industries, and then there's a lot of sort of minor uses like gasoline blending and crop drying. So yeah, I mean these are it's a very sort of small and niche product, or used to be anyway. And it's something which has grown a lot over time. When it originally started, it was obviously always just a byproduct. It was kind of one of those things that people didn't really quite know what to do with. They were trying to find ways to get value from it. They're trying to find use cases for it. And a key part of that was obviously how to transport it as well. So obviously there's keys in the name, Liquified Petroleum Gas. You have to find a way to make the gases into liquid form. So the way that people have normally done this was, traditionally it was through pressure. So the small pressurized ships would apply enough pressure to get the gas into a liquid form. And then over time, technology evolved and they started using refrigeration. So if you could get propane down to around -41 and butane down to around -4, they would be in a liquid state and therefore easier to transport by vessels. So today, the main sort of supply region would be the US and the main buyer would be China.
Okay, and these are what I guess my neck of the woods are referred to as NGLs, natural gas liquids. Just a couple of basic questions. Do propane and butane come together mixed, or are they separated? Do they have different uses there? And just obviously shale plays a big part in this story. Has NGLs, LPG always come from those two sources, i.e. oil and gas production and from the refineries, or is it really the advent of shale that actually launched a big source of production?
If you are using them more for a kind of petchem use case, then you typically would have a sort of higher propane or maybe even full propane kind of ratio. If you're using it for more sort of heating and cooking uses, especially in countries where it's warm, you need a higher ratio of butane to be able to bring the boiling point up. So basically, you want to be able to transport that LPG as efficiently as possible. So yeah, so typically, if you're getting them out of the ground, you split them, so you don't have propane and butane normally mixed, and then even if you're using it from the US, you'll split them even again further to have isobutane and normal butane separated. In terms of shale gas, I mean, obviously this is was a new angle for oil and gas production. It was just a cheaper, more efficient way of getting out the ground, and that has had a profound impact on LPG because there's just been a sheer increase in volume, a huge increase in volume coming from the US because of the shale gas play. But obviously, those decisions were made primarily for the oil market. They weren't made because people were trying to get NGLs out of the ground.
Yeah. Just out of interest, which are you happier to find, propane or butane?
I think it kind of depends what you're looking to do with it, but I would say that the propane market is by and away far larger than the butane market. It used to be a case where you couldn't even export butane out of the US, and then it started in very small amounts, and now it's much bigger. But typically, most of the markets around the world will need more propane than butane.
Great, thanks for that. Can we contextualize what sort of makes LPG, the market, the trading of LPG and the supply chain unique, and why it's an interesting and relevant story, and one that has lessons, learnings, and direction of travel for other liquid commodities?
Yeah, sure. I mean, so I think what's really interesting about LPG. I mean, it's a fantastic industry. It's very close knit. Obviously, it's like any market space. You have highs, you have lows, but overall, everyone is just working hard to try and do the best they can and make a profit. And I think in terms of the way that people approach that, it's very different to other products. Typically, what you'll have is you might have someone who only trades derivatives in a certain commodity, or they focus on chartering ships for that certain commodity, or they might trade the cargo and negotiate contracts around that. In LPG, it's been quite common to always have a person who can do all three. So they're constantly looking for the value between the cargo, the freight, and the derivatives, which is quite unique. So obviously, seeing over recent years the kind of explosion in this idea of freight trading, you've got people dedicated to extracting value out of shipping. That's something that's very familiar to the LPG industry because that's something that we've always done. You might actually have a completely different view on freight in terms of where the value is going to go versus, let's say, the paper market or cargo values. So, that kind of gives you a bit of a unique perspective because you know just as much about charter parties as you do about Incoterms, as you do about future contracts, which obviously in most commodities, they separate all that out.
Can you just give us, we haven't really talked scale, how much of the barrel are we talking here? And then secondly, can you just set up how that supply chain works? So you've got traders that are doing that sort of triumvirate. Does that marry over into, in the physical market, that typically the refiners, producers own their own ships, for example, own their own processing? Kind of, how does that all piece together?
Yeah, I mean, for sure. So, I mean, we're only talking about sort of 2% of the barrel. That was always the kind of discussion about, LPG being so niche. That's a good question. I think it evolves, in all honesty. I think sometimes, you have oil majors who have a big freight, cargo and derivative position in LPG. Other times that will wane and they won't have such a big position. I think definitely the trend has been that more ship owners want to be trading cargo themselves. More traders want to own ships themselves. Everyone's investing in terminals and storage facilities and distribution businesses. So it is definitely going along the same sort of lines that a lot of other commodities have, which is that people really want to embed themselves in the supply chain through JV partnerships, through acquisitions, through many different sort of avenues. But yeah, definitely it's something which that reflects the fact that people are trying to gauge where the best value might be. And I think you have to kind of also distinguish between, obviously, a trader will have a view, or a trading team will have a view on, the value of freight or the value of cargo. But that's obviously not going to be the same thing as a whole business deciding that it wants exposure to shipping assets, or if it wants, long-term cargo contracts. They're kind of different priorities, really, or different approaches. But yeah, it's definitely an industry which has gone along the same sort of lines as other commodities in that respect.
Yeah, and in a moment we'll talk about what changes have occurred since 2010.
Yeah,
just going back to kind of that sort of somewhat of the uniqueness of the industry and the interplay of sitting over the cargo, the derivatives, and the shipping with one trader or one trading team. how does that? Can you give us sort of a vignette? Sort of, I mean, how does that play out, and how would it look different and a bit unique compared to someone who's perhaps more familiar with whether it's LNG or crude?
Well, I just think it's the approach you take in a trading strategy. I think that if you are really just focused on chartering a ship and that's all you do, or you're looking at just trading the derivatives, then obviously there's a real limitation to kind of where you can see value. Whereas when a trading team is looking at everything all the time, should we take these FOB contracts? Should we charter in these ships on time charter? Is it better to have a CFR contract instead? All of these things, they give you more tools to take positions. They give you more sort of visibility on where the market will actually go and how you can kind of leverage that, which is really rare. As I say, normally it's kind of these silos are built up in other businesses where they can't actually see, okay, well, that's what the chartering guy is seeing on the shipping market. Maybe we should sell FOB instead and charter out our ship, instead of lifting it ourselves. So to be honest, Paul, I'm not sure. I can give you kind of more technical guidance on this just for your own info, but I don't know how technical you want me to go for the discussion. But just for your own guidance, to give you an example, let's say you have a cargo and you've got a ship, okay, and you go, right, okay, I can load my cargo and I can use my ship and I can sell it into Asia, and that's the CFR market, okay. But because the value of all those three elements fluctuates, it might make more sense to actually sell your FOB cargo at the load port, charter out your ship to someone else, and buy a delivered cargo to cover the short you had in Asia. So the idea of that things are static, that, okay, because I have this cargo and I have this ship, I have to move it into that short. That doesn't really apply. You're constantly looking across the three elements and saying, okay, well, maybe I mix all of this up. Maybe actually I sell my FOB, I charter out my own ship, and I buy from someone else to cover my position in Asia. And that might give you even more value. And I think that was the cool thing that I've seen in my career, is that, initially we kind of applied a very small, short, sort of nimble approach to a much bigger system. Nothing is ever static. Just because you were planning to load an A and deliver to B on your ship, that's not fixed. Even to the last minute, you can always switch it around to optimize, make more money.
Yeah, it's interesting, isn't it? Because we've done a few episodes on shipping and tankers, and how a lot of the volatility and the risk is transferring to sort of that side of the equation. And, and in some ways, this cadre of LPG traders have been doing this for quite some time. And you can imagine that as other markets evolve, like LNG and so forth, we'll come on to this, of course, those are going to be skill sets that are kind of in demand and transferable. Let's talk since 2010. Okay, so, and all of this is in the context of shale, which has a incredible transformation of the NGL's LPG market. Can you sort of help us understand what that wrought?
Yeah, for sure. These numbers, the way that the market has exploded, the LPG market exploded over the last sort of 14, 15 years, you're talking almost sort of crypto territory, to be honest. When I first started in the industry, there was maybe 5 to 6 VLGCs loading a month out of the US, and now it could be like 100. So this is a real explosion in volume, primarily driven by the shale gas play. Obviously this move that the US has made towards self-sufficiency and greater production basically created this oversupply of LPG. And again, I remember people used to say, oh, where's it going to go? How's it going to find a home? What's going to happen? But obviously it did. And primarily that's gone to China. China in 2010 was importing maybe sort of 3 million tons, something like that, 3.5 million tons. And now it's 35 million tons. So, again, a sort of tenfold increase over that period. And I think what's really interesting as well is the kind of reason for that buying. In 2010, there was not a single PDH importer in China. So a PDH unit is a propane dehydrogenation unit. So they're obviously making the propylene from it for plastics. And there was basically none of these imports going into China at that time. And yet, probably last year, it got to around about 22 million tons of demand there. So this is a huge development where, the Chinese market saw that there'd be this oversupply, this abundance of feedstock from the US, and they prepared themselves and built these PDH units that were able to capitalize on that. So that's one major sort of source of demand. But I mean, we've seen similar patterns elsewhere. Indonesia's gone from less than 1 million tons to about 7 million tons a year. If you look at India as well, that's gone from maybe around 9 to about 18. So across the whole market, the shale gas explosion has really driven this oversupply of LPG that then had to find homes elsewhere, and that did happen. And I think to sort of coincide with that, you obviously saw a huge explosion in the VLGC market as well. So, again, when I started the industry, there was probably just about 120 VLs, something like that. And now there's more like 370 odd. And
very large gas carriers.
Yes, that's right. Yeah, very large gas carriers. Yeah, so and they're only getting larger. So they used to sort of carry, the small ones maybe 42,000 tons, 44,000 tons, and now they're planning to build them that can carry 50,000 tons.
And this is because in some ways refrigeration is cheaper, or the construction of these ships is a lot easier when you're using refrigeration as opposed to compression.
Yeah, I mean the pressurized ships always had a limitation in terms of size. They could never really, the hulls would be too thick. It would be too expensive to transport it in that way. So yeah, the refrigeration really is what drove it to becoming a bigger market. And obviously, like I said, we needed almost a trebling of the VLGC fleet just to be able to carry the abundance of gas from the US.
Just before we move on to that market efficiency piece and how the market's changed, just out of interest, what is the scenario where shale didn't happen? Are then refiners absolutely coining it because they're the only source of, or the major source of LPG? Do you have a China doesn't become sort of the plastics manufacturer of the world? Like, I know that's a bit of a counterfactual, but yeah.
Yeah, I mean, it's a great question. No, it's a difficult one. I mean, it's funny because before shale, the US really kind of fluctuated between being potentially an importer or an exporter. Different times it was either kind of balanced, maybe slightly long to slightly short over its kind of history since the discovery of oil and gas and LPG. But the shale gas really changed that, It basically drove sort of a one-directional arb from west to east. So, again, when I started the industry, if you were loading a cargo from Nigeria, there was an equal chance it could go to Europe or to Asia. I remember even there was an occasion where there was a whole flotilla of VLGC ships sat in the North Sea because it made sense to bring them from the east. I mean, the shale gas dynamics completely changed all of that. It would just be impossible. It's just too much. So I think, yeah, to answer your question, for sure, the China would not have had access to all this cheap feedstocks for plastics. And on top of that, you probably would have remained far more niche and far more inefficient as a market. The shale gas really transformed.
Yeah, it's just interesting because, I mean, you put this in the context at the moment of kind of a lot of, there's been a lot of hand-wringing in Europe in the period since the global financial crisis, when at that point Europe and the US were roughly equivalent in terms of GDP, to now a stage where the US is double Europe. And you often feel that the shale revolution, is left out of that narrative, right? There's a lot of focus on sort of policy and regulation stuff, but I mean, the incredible wealth generated and just the utter transformation of the global economy as a result of shale is often, I feel, sort of overlooked.
Yeah, I think that's a totally fair point. But I also think as well that there is there's a cultural thing at play here as well. And in terms of how risk is approached and in terms of access to capital and everything that goes along with it. I think in the US, if someone fails at a business, there's almost no stigma attached to it. Whereas there can actually be serious financial ramifications for people in Europe if something goes wrong. So I think in terms of like culturally, that sort of risk-taking approach, yes, it was reflected very well in the shale sort of phenomenon. But I'm not sure, the difference in GDP is just because of that. I think there's a whole kind of other identity to it that drives that forward.
Yeah, yeah, no, absolutely. Okay, so you get this huge expansion in supply. There's a ready and willing buyer in China, and obviously have anticipated that and positioned themselves well with these PDH units to be able to capture it. That also drives, you alluded to, this far more efficient market. You've got many more, much larger ships. Can you tell us how the market for LPG transformed?
Yeah, I mean, I think there's been a few sort of key developments, but I think one that really shows it nicely was the sort of expansion of the Neo Panama Canal. So again, when I started the industry, there were only four VLGCs that could actually transport cargo across the Panama Canal, and now most of them can. And that is a huge shift, because if you think about it this way, if you're going from the US to Japan, which used to be the major importer for LPG, you're looking at a kind of, I'd say, 95 days round trip, something like that. But if you can go via the Panama, you cut that back down to basically about 2 months. So it's a huge efficiency in terms of you can get the cargo from the source to where it's needed in such a faster time. And that means that these sort of peaks and troughs that you see in prices, the way that people approach the market, it adapts, because people go, well, I can get my cargo. The people start moving from term contracts to spot contracts because they're not still scared about missing out on feedstock. So that, I mean, that's kind of like one example, but it plays through in everything. We used to worry a lot about US fog. Suddenly that would shut down the Houston Ship Canal and you couldn't get the cargo out of Houston. And that's been, managed, and people found better ways around the logistics of doing that. Another big element is storage facilities. The sheer scale of storage facilities now, especially in places like China, means that people can buy cargo when it's cheap, store it, and then use it when they need it. They're not so reliant on, okay, I'm still waiting for my cargo to arrive that's 3 months away. So in general, the market has definitely become more efficient, and that is what happens with logistics. It goes from this kind of inefficient state for niche sort of nascent markets, and that sort of unpredictable trade flows. What I mentioned earlier, you didn't know where a cargo from Nigeria was really going to go. You didn't know if the cargo from east was going to come west or vice versa. And it changes to very efficient, which makes it very predictable. So suddenly exactly, okay, 99% of the time the cargo is going to load in X and go to Y.
The energy and resources sector is experiencing unprecedented change. To help companies navigate this world and capture its opportunities, HC Group launched Enco Insights in 2023. Enco has rapidly become the leading global expert network dedicated to energy and resources. Enco Insights leverages HC Group's 20 years of connections and dedication to the sector to give clients the expertise they need to take decisions fast. Connect with Enco's experts for anything from a 1-hour insight call to a longer-term consulting project at encoinsights.com.
Who's building this stuff? Who's building the ships? Who's building these storage terminals, the infrastructure? Is this, can you give us some context on that, particularly, I guess, on the storage side? Is that the traders? Is that the producers? Give us some context there.
Well, I think it's a mixture of both. I think the shipping side has changed quite a lot. It used to only be sort of Japanese shipyards and then Korean shipyards, and then Chinese shipyards really became very competitive and very advanced. So they took a much more of a bigger share of the sort of new build market than they ever used to have on the shipping side. On the storage side, I mean, again, this actually adds towards the efficiency piece, is that the US market has been really practical and flexible with how cargoes are stored or loaded. So in Mont Belvieu, you've got the salt dome caverns. So if you suddenly decide that actually it's not worth it to load the cargo, you can pay a fee and store that cargo in the salt dome cavern or cancel it. Whereas if you're loading out of anywhere else, whether it's the Middle East, West Africa, the North Sea, you don't have the option. You can't just put the cargo back into salt dome cavern. So from the supply side, that became quite efficient for people to kind of use. And then on the buy side, I would say primarily the biggest sort of end users were more sort of incentivized to build storage facilities. So, there are companies, for example, in China, whose main focus is on petrochemical sort of uses, and they have built storage facilities which, let's say for one company might be bigger than every single storage combined in Europe, for example. And so suddenly you've got the flexibility to kind of store cargo in the US as the major source, and you've got flexibility to store cargo, in China as the major buyer. So it's that as well helps a lot with making things efficient.
Yeah, and how have, so we're also talking about obviously the derivatives piece as well. From a cargo perspective, how has that all changed? What are we seeing in terms of volumes, demand, and so forth?
Yeah, I mean, look, again, when I first was starting in the industry, there basically were no FFAs for LPG, and even the derivative market was very, very nascent. There's almost sort of no one really trading them. They were kind of use them for.
We should say you haven't been doing this that long, though, right?
Well,
this is
2010 to 2012. I mean, there weren't that. I wouldn't say there were many like curve shavers in the market giving liquidity to LPG swaps at the time. If you think about it as well, pre like Dodd-Frank and MiFID II and everything else, the requirement to actually clear these via an exchange wasn't there. So people were still entering into bilateral paper agreements, to execute any sort of volume. So I don't know. I mean, I don't know how that kind of compares, Paul, to all the discussions you've had and everything else. But I mean, LPG in itself is also still quite far behind at that stage. The market would swing pretty wildly because there just wasn't much liquidity at all on the paper side. And that's completely changed. Obviously over the years you did have curve shavers entering the market, more funds, people who are obviously trying to hedge more physical volume, and that increased flow. So yeah, I mean, it's completely transformed in terms of the value.
What's happened to the actual contracts themselves? Have they become more granular, more swaps contracts available on exchange? I mean, what sort of, how is that then reflected in the types of contracts and the liquidity around them to manage this?
I mean, it's in terms of like the way they've evolved is basically that they're just more clear in terms of like, the exchanges terms with ICE or CME and companies like that. I don't think fundamentally much has changed in terms of how the indices are actually calculated. Primarily, they still use the same, PRAs to report, what the values are. They're still settled in the same way, cash settled. So I wouldn't say there's been too much of an evolution in terms of that. I think on the FFA side, they've added more routes. So as ARBs have changed and trade flows have changed, they've had to add more routes to the FFAs. But I'd say in terms of the actual cargo derivatives, they're quite similar to how they always were.
Okay, and we're going to sort of come on to a little bit of, somewhat of your philosophy about sort of a bell curve of how these commodities go from sort of nascent to mature and what that means for market participants in the market itself. Just before we get there, can you what happened in COVID? Did we see similar sort of negative pricing? Did the supply chains shut off? What happened then?
Yeah, I think it's a good question. I think what was nice about the LPG industry, what is nice about the LPG industry, is that it is its own microcosm as well. Although it's only 2% of the barrel, and although obviously, Brent crude drives the flat price value for propane, it can function in its own little niche as well in sort of unpredictable ways. So, during COVID, obviously crude tanked and, even for WTI went negative, but actually LPG was relatively firm as its own market structure, because when OPEC started cutting back cargoes to support the crude market, that also cuts back LPG supply from the Middle East. This is something that people have to keep an eye on when they're trading LPG, is that, okay, whatever OPEC agrees will also have an impact on what happens with your next month's cargo. You might be banking on that cargo from the Middle East to supply a short in Asia, and you'll find out maybe with 10 days notice that it's no longer there. So, I mean, that has a huge impact on sort of supply and demand balances. And so that's obviously contributed to a slight tightening during sort of COVID, especially in the early days. And then from a demand side, in India, a lot of people who were previously working in just the factories and in offices, they had to kind of go home, and they obviously had to burn more LPG at home for the heating and the cooking, and that added extra demand into India. And likewise in China, obviously going back to the sort of PDH demand and making the plastics, there was a huge global demand for PPE, personal protection equipment, and they were importing a lot of propane in order to build that equipment. So, you might look at the sort of whole energy complex, especially sort of oil and gas products, and think, okay, well, this is very bearish for crude and bad news, therefore it must be the same for everything. But then it can operate in its own kind of microcosm as well. And I think, if you then extrapolate that across other kind of geopolitical events and other shifts, if you take Trump's first presidency, there was the US-Chinese trade war, and we saw that play out in real time in terms of that suddenly the imports into China fell off a cliff, and they were actually being sold more into Japan and Korea, and the Japanese and Korean trading companies were then swapping and giving their Middle Eastern cargo into the Chinese market, but obviously, charging a fee to do so. And, that meant that in any situation, even in the trade wars, there are winners and losers. And I think, just one last kind of example is obviously Ukraine. For certain markets, it'll, the war there, will have a huge impact, and it did. I'd say, the level of Russian exports of LPG were fairly limited to the kind of the Baltic and the Black Sea on a global perspective. So that hasn't had as much an impact on the LPG sort of ecosystem. There's been more imports via Poland and everything else, but I think compared to some other commodities, it's not had anywhere near the same impact. So yeah, so I think LPG, and by that I mean predominantly propane. It has a very exciting dynamic where yes, it can be pulled from pillar to post by these huge geopolitical shifts, but it can also function completely independently, and it's trying to find the skill to determine between the two which one you need to put more focus on at the right time.
Yeah. It sounds fascinating, and trading on hard mode to some extent. So we've discussed your theory of this sort of this pattern and evolution to how commodities, the markets, become established and then mature, and kind of the end state maturity as well. And there's lessons in there for LNG and how that market is progressing as well. And I think this is important because obviously traders, marketers need to build the capabilities to manage that shifting dynamic and recognize it. Can you give us, I guess, your theory on that in the context of LPG?
Yeah, I mean, sort of going back to how we sort of discussed earlier on about logistics improving and what that means for trade flows, that they become more predictable. I think that then feeds through to also information. Again, when I first started, the information was very regional. There were silos between different kind of types of buyers and suppliers, and that means then that actually the whole market is far less transparent. And over time, as the sort of logistics improves and things become more efficient and more predictable, the information itself becomes global, and there are fewer silos. So in terms of the way that impacts then on kind of market value, when you're looking at nascent earlier markets, you're looking at a situation where you've got smaller scale logistics, you've got maybe experimental use cases, you're not quite sure exactly what you're going to use it for. I mean, believe it or not, they actually tried to use butane to keep aeroplanes in the air at one point. So basically everything's up for grabs, and market value is determined more by events. Has there been a war in a certain region, or is there bad weather in another region? Whereas again, because when logistics become more efficient and information becomes more transparent, and all the use cases for LPG are pretty much fixed for the moment, things become trend driven. How market determines value is more a trend. Did you call the trend right of tightening freight markets for the long term over the next 3 to 5 years, or did you call the export position from the US based on shale gas correct? Or it basically shifts far more to a kind of trend driven approach rather than kind of a market event on a smaller scale. And then that naturally has kind of impacts for where a trader focuses to make profit. In sort of more nascent markets, like let's say, how LPG used to function, you would look at it and you're trying to find optionality and you're trying to optimize your system. And those are the two kind of main frames of way that you'd make profit. Whereas when, as I said, logistics becomes more efficient, information becomes more transparent, things are more trend driven, you need to have that structural sort of longer term view to really make profit. Everything's too efficient to find the optimization route to making serious gains.
That's fascinating, isn't it? Because this is somewhat ties into this sort of big question that's out there at the moment, which is commodities trading renaissance here to stay in the wake of, the energy transition, the increasing disruption to global trade, digitization creating a lot of volatility, but also the need to embed more risk management in a system? Or actually, are we just seen a unique period of volatility with a European ground invasion, a global pandemic, the tariffs and the rise of populism, that we've just had sort of another period, 5, 10, 5, 6 years, whatever it's been, of higher returns for trading. And the thought there is, in the absence of big events, these markets become highly efficient. Yes, there's money to be made optimizing day to day, but it's not as much, and it's probably more about risk management for events or capturing events when they come up. But actually, the big plays are we going to invest in a global LNG business, right? Or are we going to build out a global LPG business and capturing that sort of the mega trend of, like you highlighted, right, when realizing that shale was here to stay and that presented lots of opportunities to build petrochemicals business in China. That's actually sort of or sourcing a long-term crude deal from somewhere. That's where sort of the value drifts or goes to, which, sort of, I guess, also has profound impacts on what key talent you're looking to resource and so forth.
Yeah, I think it really depends on the commodity. I think if people can find a commodity which is nascent enough that you've got that, inefficient logistics and unpredictable trade flows, and you've got regional silos of information, and market value is kind of driven by events, then how you approach that to make profit is very, very different to the alternative. And so it really comes down to the nature of where that commodity is. So, in some ways, as you mentioned before, LNG is earlier than LPG in terms of market maturity, and then you might look at more of a commodity like coal to say it's further along, and that's kind of where that bell curve idea comes in. Is that you go from inefficient and sort of less transparent to more efficient and more transparent, and then due to regulations or just society, it might go back again to being more inefficient and less transparent. So that's the kind of like bell curve idea of how these commodities and the pattern like really goes along.
And it's relevant though, isn't it? Because at the moment, obviously, we're seeing a slew of potential new commodities, covered in depth on this podcast, but obviously ammonia, green ammonia, hydrogen, etc. And you are not going to be able to capitalize on those big trends, unless you're sort of there at the early stages trying to figure out the market, even give some direction to it, capture that sort of event-driven volatility and optionality, in the early stages. And I guess that's sort of the argument to say, get in on the left-hand side of the bell curve, even if it's a limited investment, but trying to understand those markets, because that will give you that option to actually go large if it starts to trend as a more established commodity with a with a more important and global role in economic society.
I mean, for sure, absolutely, and I think it's also it's a lot of fun. I think if you find commodities which function like that, and you're in the early days, and you're shaping the market, and you're getting the optionality and everything else that you would want for contracts, they're fun to trade. So I think, like, in terms of anyone who's thinking of that, they should definitely consider it. And I guess the only thing I would say is it is useful to try and take the commodity trading approach maybe from one commodity to the earlier ones that you're now looking at. As I mentioned earlier, for me, the sort of three pillars of commodity trading are cargoes, freight, and derivatives. So if you understand the Incoterms and how to approach cargo trading correctly, and you understand charter parties, and you can then approach freight markets correctly, and then you also understand the derivatives, bringing that to a more nascent market is really useful, because you then can go, okay, this is where the value is. Or even something as basic as, does our position actually reflect our view? I think the amazing thing about trading companies is sometimes they get so big and they've got so many sort of legacy decisions that you can have a trading team together and everyone says, well, actually, I'm not sure I really am that bullish shipping, but you're so long ships. Or, you might think, actually, we're trying to get this contract to sell a short into Asia, but are we even bearish cargo? Do we think that cargo is going to fall enough for us to be able to buy later at a cheaper price? These are the questions on value, which are difficult and they're uncomfortable and they're based on human judgment. But it's something which you can actually pick and choose from other commodities. I personally know people who have gone from LPG into the LNG market, and they've taken LPG concepts and ideas and deployed them there. And also even to other markets. I know people who might have taken some sort of ideas and concepts from LPG and applied them in Aframaxes or something similar. So
yeah,
I think
biofuels is probably another good example, right, where you've had this effectively a new industry, come along, and it's still going through that maturation, but it's very much dependent on cargoes, derivatives policies as well, of course, and the shipping.
Well, yeah, I basically think you can break down pretty much every commodity market into those three pillars. That's something I believe in. And I think if you can correctly understand, where the risk lies with each one, where the value lies with each one, what your view is on each one, I think you're better positioned to capitalize on a market than if you're just looking at one of them. And I think that's the mistake that quite a lot of people make, either with new commodities or with later ones.
Yeah, no, absolutely. And we have seen the rise of obviously shipping teams, chartering teams within the trade houses and even within the majors and producers, because precisely that. Okay, in the last few minutes, what does the future hold for LPG? You mentioned humans making decision, technology, as with all these sort of being able to overlay technology on what is quite a known global map in terms of cargoes available, port space, demand, and all that. So you can imagine that actually technology, AI, of course, is going to be significant in getting a competitive advantage over making these trading decisions more quickly and with more fidelity.
Yeah, I think it kind of depends on where the commodity is on that kind of bell curve. If you can extract enough value from optimization, from optionality, if there's enough kind of opacity to the market, if the logistics are inefficient, you don't really necessarily need that much technology. I think if the market gets far more efficient and information is transparent, then yes, technology really helps. It's something which is based on a longer term view and a trend. And, I've spoken about this before, that, people can panic, about technology. They hear about, Bitcoin or DeepSeek or whatever else it might be. And they think, oh, this just sounds like witchcraft. But there is a fundamental, shift that underlies all of this transformation that's going on. And that is the collapse in the cost of storage. And I'm not talking about storage of commodities, I'm talking about storage of data. So, with the collapse of storage of data, people are finding more uses for that data. And that essentially means more prediction and more analytics. So I think the sort of underlying process we're going through means that in markets that are not as nascent as they used to be or are a bit more mature on the curve, technology is definitely something that can be leveraged to good effect. And it's something which gives people a far more of an impact because it's not heavily capital intensive. It's not something which will take 5 years to be developed, and it's something which can make a meaningful difference to businesses. So I think that's one thing that the future holds for LPG and for other commodities like it. I think obviously there's still going to be people trying to optimize logistics even further. So you may have seen recently, obviously, co-loadings of ammonia, with LPG. In the past, there's also been co-loadings with petchems and LPG. So people are constantly trying to find a way to lower that dollar per ton cost and land cargo at the cheapest way. And so I think we'll see more and more of that. I think the US is interesting. It's going to be, there's question marks over, I know obviously Trump wants to drill. He's made that pretty obvious. But whether or not it happens to the same extent will obviously depend a lot on Wall Street's appetite for funding those ventures. It will depend a lot also on the technology, and the fields themselves. Fields can run dry, no matter how much money you have. So I think it just depends really, how that plays out. Some people say, it is going to get a bit tighter in the US market, and other people would never write off the US market to find a way to produce more. I don't know if you've got any view on that, Paul.
Well, I mean, I get asked this question. I'm but a humble recruiter, but unless I'm wrong, the oil market in the US is in the hands of private companies, and so unlike OPEC, where you're looking at a governmental decision, all these decisions are the government's impacting by regulation about where and how you can drill, but people aren't drilling in Alaska because of the price, not because of the environmental considerations, I would suspect. So I think that the market will decide, and and as you highlighted there's probably as much concern about shale being a shorter term play because a lot of these fields are rolling over than there is necessarily sort of it being governmental driven incentives. So yeah, I think the US is absolutely drilling, and will continue to drill if it can, and it makes sense. And we covered that on a pod with Matthew Bernstein of Rystad, talking about sort of that shale evolution. But so there's it definitely sounds good in a soundbite, right?
Yeah, I think so. And then I think obviously building on that, we've got a potential another trade war coming. Again, we don't know if it's actually going to happen, but if it does, there'll be the same sort of winners and losers as before. I think that trend towards efficiency continues. There's a lot more VLGCs on order for next year to be delivered. People have realized that, okay, there is a bit of a risk element to have all of the PDH units in China. So, there's going to be more built in places like Poland and Turkey and Belgium. So again, the market is finding ways to get more efficient, to use the feedstock in the most geographically advantageous way.
Yeah. One final point was there was quite a lot of talk a while back, 3-4 years and further, that LPG would have this role as a transition fuel. When you thought about Caribbean islands, whatever it might be, pipelines are impossible. LNG is a really large project, challenging infrastructure. And actually, you could just get these power stations that are typically, fuel oil, or gas oil, converted to LPG. That would be a great win for the environment, and actually a win for the locals as well, both not in just terms of health, but also cost and security of supply. Where did that story go?
Well, I think that story still exists, actually, to be honest. And it exists because the, two of the biggest buyers, India and Indonesia, are also two of the fastest growing economies in the world. So for them, whether you're looking at the number of islands in Indonesia, or you're looking at, let's say, like the Himalayas in India, they're not really at the stage where they'd be able to put in LNG pipelines everywhere. So that also makes LPG quite an exciting product, that whether it's those two countries or even, let's say, the continent of Africa, there's still a huge amount of growth to come, because these are the young growing economies of the planet, and they do see this as a transition fuel, and potentially maybe a permanent fuel, if they don't think it's feasible to really put in LNG grids like they have in other countries. So I think that's an added bonus to the LPG industry. It's quite an exciting place to be when you can see there's a definite use among the growing fast economies of the world. It's not like you're kind of dependent, let's say, on more mature, older economies to really drive the growth in the commodity.
Yeah, and then obviously it's got that versatility inbuilt in it as well, which you can develop a local petchems business at the same time. So,
yeah, exactly.
Well, it's been absolutely fascinating, Jack. Before we let you go, can you just give us a couple of words on Tradavex and how and where we can find you and what we should call you about?
Yeah, sure. Yeah. So Tradavex is a strategic advisory firm that I'm a founder and director of. And we bridge the gap between commodities and technology. So we use experience from both sides to help clients increase the revenues, diversify their client base, and future-proof their business. So to give you an example, on the one side, you might have a tech company that wants to sell into the commodity trading industry, and they feel like they would benefit from having more domain expertise about shipping and cargo and derivatives. And equally, on the other side, you might have more traditional companies, whether it's trading companies or ship owners or brokers, and they haven't got the full in-house expertise to understand about neural networks and deep learning and things like that. So right in the middle, Tradavex is there to help both sides on a strategic advisory basis.
Fantastic, yeah. And as we both know from Enco Insights, right, there's a lot of demand for that kind of knowledge base and a mixture of FOMO and greed, but change is coming, and it's coming rapidly, and there's a lot you can spend your money on in technology, and it might not yield too much. So having that sort of interface and bridge is a good thing.
Yeah, I think especially when it comes to the language of this domain. If you get other people in to kind of look at technology with you, and you have to explain to them about demurrage claims or about Incoterms, it's a lot of time and cost that goes into that. Whereas if a company already knows how all of those function, that's half the battle. It's probably even more of the battle, to be honest. So I think that's the kind of USP that Tradavex brings.
Excellent. Well, Jack, I'd love to have you on again in the future when we can talk about just that interface. But for now, I really appreciate your time.
Great. Thanks so much. Cheers, Paul.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.